Hi, Harry here for the rant on October 3rd. You can't evaluate a bubble fully until it bursts, okay? The first bubbles in history were very clear what a bubble was, like a big something for nothing, okay? Mississippi and South Seas bubble, 2 years straight up, and in the similar boom to bust ratio I have historically 70 to 30, in 1 year sharply down and down 99%. In other words, this was a bubble, folks. It was a bunch of hype about nothing, and it ended up going back to what it was really worth, almost nothing, okay? And 98, 99%, I mean, you know, these companies, South Seas companies, they were something, they were exploration companies. So that's what we need to see here, okay? This has been the longest, most stretched, everything, greatest bubble in history. And here's what I'm looking for to really prove that this bubble was not productive, which money velocity already clearly says, as it said before the going into the roaring 20s bubble. But if it really is unproductive, we should go back to the early 2009 lows. That means the entire boom and bubble since we started stimulating, you know, nonstop for 16, 17 years, entire bubble is erased. And we are at new lows that are the same as the lows back 16 years ago in 2009. In other words, once we go up and down and shake everything out, from low to low, no progress. Oh, from high to high, yes, substantial progress. But when you really shake it out, no real progress. In other words, bubbles aren't that productive, okay? Now, so with that, you know, in mind, 2026 is almost certain to be a down year. Number of reasons. Every 4 and 8 years, that 4 and 8 year cycle has been way back, okay? It will be the bottom of the 4-year classic cycle. And sometimes that just means the markets go more a little sideways, or they can go down substantially depending on other trends, okay? But 2026, but we've had such an incredible run, greatest 16, 17 year bubble in history. And since 2020, the normal 5.5 year bubble time frame, this has been a stupendous bubble. So you don't expect a minor downturn after that. And in general, in the stock markets, and again, you know, I've been studying these all my adult life, tops tend to occur 90% of the time in odd years, don't ask me why, and bottoms in even years, okay? So I mean, in other words, if we're going to top here, late 2025 is a darn good time, just like the last top was late 2021, okay? 1929 was an odd year, and 1937, you're going on and on and okay. And if it's going to bottom, 2026 would mean, oh, it's just a sharp correction, so that's not what I'm expecting. A real bubble crash takes 2.5 to 3 years, and that's also the same as 29 to 32 in major bubbles like that. Well, that would put us in 2028, and I would think more like early to mid 2028, okay? But again, to go back, we have to remember 2022, in my cycle work, the 90-year, which is the bubble, super bubble cycle, okay? The strongest medium to long-term cycle in stocks and economy. That is bottoming, should have bottomed around late 2022 from the 32 bottoms in 1842. Before that, the biggest crash bottoms in American history, okay? The 40-year cycle, generations, okay? That would hit in late 2022. And of course, the decennial cycle, down for the first 3 years off and on of every decade, late 2022 again, 2020 to 22. All of those cycles converged. So this stimulus, I mean, and we did actually have, the only serious correction we've had in a while was in 2022. That's draw was so hard to say, but that's nothing burger compared to the bubbles we've had in cycles, okay? So that was not a long-term bottom, right? No question with a crash that small, okay? Now, So wiping out most of the gains is what we want to see here. And again, that's exactly what going back to the '09 lows. So if I'm right and we do start to go down substantially in 2026 and maybe a good bit longer, if we just go back down to the 2020 lows, that's not erasing, this massive bubble. And even 2015. So 2009 says this is the greatest and the longest bubble in history, and still, like every other bubble in history, including 29 to 32, that wiped out all the gains and more from the whole roaring 20s bubble part of that boom, okay? Despite all of this, it was still unproductive. In other words, having bubbles, encouraging bubbles, doesn't pay. Sometimes they occur naturally. They still don't pay, okay? Naturally just means people get overexcited for too long. 5 years, see? Normally 5 years, 6 years max that you can keep a bubble going. This one, because of nonstop, escalating, massive, 29 trillion, 1.5 times of the average GDP in that time. I mean, just massive stimulus. They've been able to keep this going this long. But it should crash hard. If it doesn't, then we haven't gotten all the excesses out, and it will hamper. I mean, the whole point of recessions, as I always stress more than hardly any other economist, that everybody sees recessions as the enemy. I don't, okay? Can't eat without crapping is my thing. You have to have both to keep marching forward, okay? So recessions aren't bad, and you're the more bubbly or more overstimulated, or the higher the debt, boom, the bigger the recession you have to clear out the zombie companies and the bad debts, okay? So that's where we're at. And today, if we go back to just the last major lows, which was 2012 in stocks, for gold, it was late 2015, okay? That would be a 70% crash, even in gold, which normally gold didn't go down that much in 2008 compared to all the other assets. And it held up a little longer, but it still went down, still crashed 30, 40% at worst, okay? But gold would be down 70%, the S&P 500 down 90%, and the Nasdaq or the QQQs, which is the most traded ETF in stock, down 95%. So that's what we're looking at here, folks. All we can do is be sane when everything else is bubbly and insane. And again, the longer stocks go up, the longer a bubble goes up, the more people think it'll just last forever. We've died and gone to heaven. It's only the smart money that looks at a trend and says the longer it goes up, the more risk. That's the way the smart money thinks, because there's more to shake out. Again, even in the healthiest booms, you're going to have failures. Companies are always investing in stuff, trying, borrowing, investing, taking risks. And some of those are always going to fail. In fact, a good many are going to fail. Even in healthy booms. Well, this is an unhealthy boom, a bubbly boom. Money, interest rates were lower than usual. Money was easier to get, flowing around. Stocks going up, rewarding everybody faster than they should. So you're just going to get more excesses. So we really need to continue to be safe here, especially into the end of this year. If this is going to be a top, and it looked like it already was topping with Bitcoin at first in August, and then stocks just after that. But now it does look like, with the recent runs up, Bitcoin's up near its highs, stocks are bouncing, almost sure to get new highs in Bitcoin. Again, I expect the ultimate highs this year now, the targets to look for, 130,000 of Bitcoin. So that's not much higher than the 124.5 it already hit. 620 on the QQQ. It's already hit 606, I think it is. 6,900 on the S&P, and it's already hit over 6,700. And 200 on NVIDIA. So the two darlings, the two really bubble individuals I look at is Bitcoin and crypto, and NVIDIA and the AI, okay? So NVIDIA finally hit, and this I've been waiting on, finally hit the top trend line it's been in the last 5 years. It was the last thing. S&P, QQ, Bitcoin, everything else has hit those top trend lines. NVIDIA was the last one, and it just hit it yesterday at 190.7. 190 was right on that line, okay? And it's pulled back a little bit, and it could have a little throw over, but now Everything is complete. We just have to wait for this crash to start. If it doesn't start by the end of this year, then it may not start yet. But again, don't be eager and jump back in or think we made the wrong decision to something now. Give it till the end of the year to at least see something that looks more like a top and then starts to go down more sharply. And remember, from one of the best little pieces of research I did, every stock bubble in history back 200 years first crashes 42% in 2.3 months, anywhere from 28 to 50. Most of them are 40 to 50. And again, so if this crash starts, we could see a sharp crash before Christmas, by the end of the year. So again, I will keep you updated, obviously. Keep checking your updates. We are in a danger zone. Don't believe the stock markets. They're going to go up as long as they get away for it. But when this thing goes down, it should be the sharpest, biggest crash in history. And I mean first crash. Not the whole thing, 80 to 90 to 95%, which any bubble. I mean, even when Jeremy Grantham says, oh, we've had the greatest bubble in history, it's going to go down 50%. He's just saying that, folks, because he doesn't want to look too crazy, okay? Bubbles don't crash 50%. Long-term booms crash 50% minimum, okay, when they go down, a generational boom, okay? But bubble booms, you expect closer to 90. So I'll leave you with that. Keep on your toes. I'll keep you updated. Let's see if we get this bubble crash start. And remember, the first one's the sharpest and fastest. So don't be complacent here.